Long-distance runners know that winning the race is not about speed. It's about patience, discipline, and perseverance. The same can be said for investing. I'm Mark Kinney, Chief Investment Officer at Newport Private Wealth, with your third quarter investment update. The twists and turns of the past 3 months have left many feeling exhausted. Pile on the ever-changing headlines, and it's easy to understand why staying the course seems hard to do. We're reminded of what one of our managers said recently: investing is a marathon, not a sprint. The marathon that was one of the longest-running bull markets in history lulled investors into complacency. Patience was easy when risk was low and returns were high. It's when markets perform badly that risk levels increase, and that can increase worry. Perhaps you've avoided looking at your portfolio or asking the question, how am I doing? If you're a Newport client, you've done very well relative to broader market performance. Let me illustrate the point. Since the start of the pandemic, the Newport Balance Fund has outperformed its peers by more than 8%, with 33% less volatility. Within that time frame, the past 21 months have been even more extreme. In 2021, all markets were up very strongly. Fast forward to 2022, and in a complete turnaround, markets have been down just as strongly. If you invested $100 at the beginning of 2021 in a traditional 60-40 stock and bond portfolio, the gains you made in the first year would now be erased. In contrast, Newport's Balance Fund, measured against a composite benchmark of indices, minimized risk and protected capital through its diversified holdings. Even in a period of extreme volatility, that $100 is worth more today. This also compares very favorably to the performance of balance funds held by traditional institutions such as banks, insurance companies, and public investment managers. On a one-year basis, the typical balanced investment fund was down as much as 14% against its peers versus 3% for the Newport Balance Fund. Year to date, that gap has widened even further. Our track record for this past quarter continues this trend of outperformance. All 5 of Newport's mandates generated positive returns, finishing ahead of their respective benchmarks. Our goal is to participate in up markets and protect in down markets. We are selective in what we add and build liquidity to be ready in times of stress. We allow cash to grow appropriately and position portfolios defensively. Most of all, we stay the course. Let's look at the actions we've taken this past quarter to protect your capital. Most bond indices posted negative returns for the third quarter, putting them on pace for one of the worst years in history. It's why we're sticking to our strategy of maintaining a low exposure to public bonds. Those we hold are high quality and low duration. With more interest rate hikes on the horizon and cash on hand, we're content to wait for further downside before changing course. We've been building our diversified platform of public and private investments for the past 20 years. It's in markets like these that this strategy shines, providing us with alternative ways to generate returns when stocks and bonds are falling. Private debt, income-producing real estate, and mortgages provide income generation and capital appreciation. They also help to protect against market volatility. With a 35% weighting to institutional private investments, we showcased our ability to generate growth in income that is largely uncorrelated to the public markets. An example of that volatility protection can be seen in the performance of the Newport Yield and Strategic Yield funds. They both outperformed their respective benchmarks, generating income despite market upheavals. We remain focused on protecting capital in the face of double-digit losses in stocks and bonds. Apartment buildings in Canada and the US are a key component of our private investments and have stood up well under tough conditions. We're thankful to report that none of them experienced any material impact from the September hurricane season. We recently made 2 allocations in Florida and Oklahoma with one of our US real estate managers. These assets were repriced by distressed sellers at 10% discounts to comparable transactions from earlier in 2022. Turning to public equities, markets worldwide bore the brunt of a turbulent quarter. A late summer rally was not sustainable as concerns about a recession, weakened corporate earnings, and lackluster consumer demand took hold. While rising interest rates worked to reduce inflation, they wreaked havoc on stock valuations. September was the bellwether for this disarray, with the S&P 500 selling off more than 9%. This marked the worst month for the index since the pandemic-related sell-off in March 2020, and its worst September since 2002. This turn of events had the biggest impact on performance in the quarter, as our public equity managers were not immune to these wild market swings. Despite the turmoil, our managers stayed true to their long-term investment strategy. They continue to focus on great businesses that have strong long-term fundamentals. They have taken advantage of market conditions to trim positions, add to existing holdings, and make new investments. We have made small but consistent allocations to our public equity managers to keep weightings at the lower end of our target ranges. This allows us to use our liquidity as purchasing power to take advantage of opportunities as they arise. We've added more ways to generate returns and protect capital with other investment decisions in the quarter. We made an allocation of US $15 million to a global alternative asset manager focused on structured credit funds. These funds invest in bonds backed by pools of consumer, residential mortgage, and commercial loans. The manager's expertise enables it to source and underwrite attractive investment opportunities across public and private markets. In the face of a weakened Canadian dollar, we've been actively managing our currency exposure. As the US dollar strengthens, we look to lock in any material currency gains. We continue to build our cash positions. We have capital return from refinanced properties, dividends, and interest, as well as attracting new clients who are looking for a safe harbor for their hard-earned assets. We can't end this update without a commentary on inflation. There's no doubt that there's been a concern about the pace and speed with which interest rates have risen. While the pundits are looking for key indicators to demonstrate the market has bottomed out, we aren't done yet. We'll continue to monitor market conditions closely in the months ahead. It's easy to be disheartened by bad news, but painful bear markets are a necessary part of the long-term investment landscape. They also provide many good investment opportunities. We're well diversified with asset classes that continue to provide excellent returns, and we have cash on hand. We are not speculative and never go all in on any one investment or manager. We have levers to pull on and will do so with a measured approach. I'll leave you with one last thought. With a 20-plus year history, Newport's investment platform is extremely well established. We have the luxury of making different decisions than we might have made 10 or even 5 years ago. We are of a size and scale where we can be selective. We're not just buying for the sake of buying or for the sake of building. We're prepared and intentional in everything we do. Above all else, protecting your assets is our number one priority. You are in safe hands with Newport. Our thoughts remain with our clients who were impacted by Hurricanes Fiona and Ian. As the year winds down, we wish you a safe and happy end to 2022.